move on to closing entries. So you saw closing entries, one of the problem on midterms. Remember, closing entries, the purpose is to close out temporary accounts. Close out revenues, expenses, and also if there's dividends, we also need to close out dividends. All right, so just like service type of business, we do closing entries the same way. Besides that, there's a few new accounts here we only introduced in this chapter, and we also need to close them. Okay, so first journal entry here, we see sales revenue is being posted on the left side because regularly sales revenue has a normal balance under the credit side. Okay, so whenever you want to close out an account, again, this step happens at the end of the season. After a company does their worksheet, after they do financial statements, then they close some of the temporary accounts to make sure retained earnings matches with the real balance. Okay, so the balance for revenue is on the right side. When we close it out, we will be debiting sales revenue. And then we close it out to income summary. Now for some cases, as I mentioned earlier, if there's sales returns and allowances, sales discounts, its regular balance is on the debit side. So when you close it out, the purpose is to zero the balance. You'll be posting it on the right side. Okay, so all the sales-related entries, we will put it all together in the first journal entry here. Right, in service type of business, we only have service revenue, and that's pretty much it. Here for sales, there's sales discounts, sales returns that relates to sales, but it has opposite balance because it reduces sales revenue. So when you close it out, you have to close all three items. So really what's there under income summary is the net amount of sales. Originally, you thought you'd be collecting $169,300, but then you offer discounts to customer $1,400, and also they return a part of the inventory back to you, $2,000. So really, what you're getting from them, if it's cash sales later on, you'll be getting $165,900. So that's the net amount of sales, and we want to close this out to income summary. The second entry, also the same as service type of business. We close out all the expenses. Remember, expenses, the regular balance is debit side. So when we close it, we zero it out by posting to the right side. Now the only difference is that we have one additional expense account here in this chapter, cost of goods sold expense. Okay, so the blue ones are the new accounts that we introduced in this chapter. Make sure you understand the direction. If it's an expense account, close it on the right side. Revenue account, close it on the left. Contra revenue accounts are special accounts because it really reduces revenue. So when you close it out, it has the same direction as expenses. All right, so does this company overall, after the transactions, after what's summarized here, do they have net income or net loss? Mine is pretty obvious. Net income or net loss? We have net sales revenue, $165,900, and then altogether the expenses is net income because expenses altogether is not as much as net sales, right? So there's definitely a profit in the middle between the two. So overall net income, you will be using $165,900. Make sure you use net sales, not the original sales. Okay, in cases that there's sales discounts and returns and allowances, you have to reduce them. So $165,900 minus $112,800. The differences would be $53,100. So this is net income, and therefore it increases retained earnings. And so when we close out income summary, we'll be posting on the opposite side of retained earnings. Okay, so that underlying number really comes from these two. Net sales minus all the expenses. Now, if the company only has the prior three entries, if they didn't give out dividends, then there will only be three closing entries. So here's a case that company decides to give out dividends to shareholders, and this is the total amount that they gave away this season. So in this case, you also need to close out dividends. So just like expenses, dividends regular balance is debit. We'll be closing it out by crediting dividends. The dividends by nature reduces retained earnings. This is like a gift given away to shareholders. Okay, so you'll be debiting retained earnings, reducing and closing out dividends by crediting dividends. Okay, but if some of the problems, if you don't see dividends gave out, then you only have 3 closing entries. So what's the process after a closing entry? Financial statement usually comes just shortly before closing entries. So you do financial statements and then retained earnings is already at the correct balance, but we want to match up retained earnings T accounts by doing the closing entry. Right? But it's just a step before our closing entries. It's really close. Adjusted trial balance is a step before financial statements. So we start off beginning balance of all the permanent accounts. We journalize entries, post them to T accounts, summarize balance, do adjusting entries, adjust to trial balance, financial statements, closing entries, and then some companies do post-closing trial balance, but it's an optional step. And then we start all over from permanent account balances, because after you close them, there's no temporary accounts, right? Okay, so then the new cycle starts all over again. Okay, so closing really is, for some of the companies, closing really is the very last step. Okay. Now I mentioned this in the opposite sequence. I'm going to talk about